Now we shall have the foreign currency translations using the temporal method. Why it is temporal method? Because here we assume that the beta's functional currency is dollar. If beta's functional currency is dollar, we have to record in dollar, so we must translate everything into dollar. But the financial statements now we have is presented in FC, therefore we must translate from this FC into the functional currency, which is the dollar. So therefore, translation from FC to dollar is a translation from foreign currency into the functional currency, because dollar is the functional currencies of this foreign operation. First, we will translate the balance sheet from FC to dollar. As we have said before, FC is the foreign currency while dollar is the functional currency, and therefore temporal method applies. If this is the temporal method, it is very similar to the foreign currency transaction, and therefore for assets like property, plant, and equipment, if we keep it at historical cost, we should use the actual historical exchange rate. For this property, plant, and equipment 225,000, actually it consists of two batches. The first batch comes from the original PPE at the day of acquisitions. We know that at the day of acquisition, the PPE was 200,000. This PPE increased to 225,000 at the year end. Why? Because during the current year, we have acquired 50,000, so it increased to 250, but there has been a depreciation, 25,000. So 200 plus 50 minus 25 is 225. Therefore, we understand that basically for the PPE, we have got two batches. The first batch comes from the 200,000 originally we purchased from this foreign operation at the day of acquisition. For this first batch, the relevant exchange rate is the exchange rate at the day of acquisition, 1.5. Even though we know that this 200,000 PPE may have purchased it before the day of acquisition, but that is not relevant because we acquired these foreign operations only at the day of acquisition. Therefore, the earliest applicable exchange rate is 1.5. For this first batch, we use the exchange rate at the day of acquisition. For the second batch, this 50,000, we should translate it using the actual exchange rate. The actual exchange rate is 1.45 because this is the exchange rate at the day of acquisition of this equipment. So we got two batches. 225,000 has been translated to $335,250. If you have got 10 batches of equipment, you may have 10 lines here. Anyway, this is for the property, plant, and equipment. After property, plant, and equipment, we have got the inventory. If we keep this inventory at cost, we should use the actual exchange rate at the day when we acquire this closing inventory. The question says that this closing inventory was acquired when the exchange rate is 1.38, therefore 1.38. For monetary assets, like the accounts receivable and the bank, and for monetary liability, so all monetary items should be translated using the closing rate. The closing rate means the year-end rate is 1.35, so 1.35. So we have translated for all the assets and liability. Now we have to translate for the equity. Equity, first we have got the share capital. For share capital, the relevant exchange rate is 1.5, which is the exchange rate at the day of acquisition. For retained earnings, we don't have the figures for the retained earnings for the exchange rate. But now we can assume that this is a balancing figure because your balance sheet must balance, right? So therefore, this is a balancing figure, retained earnings, 315,600. Of course, later we'll explain why it is 315,600. This is for the balance sheet. After the balance sheet, we have to translate for the income statement. For income statements, we should try to use the actual exchange rate as far as possible. However, if we have got very frequent sales, we may use the average rate to approximate. Here we don't have the actual exchange rate for each sales, therefore we simply use the average rate, 1.42. So 1.42 is for the sales. After the sales, we have got the cost of goods sold. We should not use simply the average rate for the cost of goods sold because we want to reconcile the opening inventory figures and the closing inventory figures with the balance sheet. Therefore, at least we have to calculate the cost of goods sold using the opening inventory plus purchase minus closing inventory. From the balance sheet, we know that the opening inventory was 100,000. The closing inventory is 120. So therefore we can reconcile. The opening inventory is 100,000. The closing inventory is 120. The cost of goods sold is 470. Therefore, the only figure missing is the purchase. So the purchase is the balancing figure. And therefore, opening inventory plus purchase minus closing inventory will be the cost of goods sold. For the opening inventory, we have translated using the actual exchange rate. But for this case, the relevant exchange rate is the exchange rate at the day of acquisition. Therefore, the relevant exchange rate is 1.5. For purchase, we should use the average rate, 1.42. For closing inventory, we use the closing inventory at the day when we acquire this closing inventory. This is 1.38. And for the cost of goods sold, and therefore we have all the figures for the cost of goods sold. So sales minus cost of goods sold is gross profit. And thereafter, we have got the depreciation. Depreciation should use the actual exchange rate. So as we have said before, there has been 2 batches of equipment. For the first batch, the relevant exchange rate is 1.5. For the second batch, the relevant exchange rate is 1.45. And therefore, the translated depreciation will be 37,250. And after depreciation, we have got operating expense. We may have operating expenses every day, therefore average rate is a good approximation. You have got all this until profit before tax. We know that there will be an exchange difference because under temporal method, exchange difference should go to P&L. This 10,550, we cannot go downward, so that's why the other way around, we go from the bottom. We know that the closing retained earning is 315,600. We got these figures because we got the figures closing retained earning in our balance sheet, 315,600. So we work from here, 315,600, and we go upward. Retained earnings, this is a very special year. We can use the exchange rate at the day of acquisition for the opening retained earnings, which is 1.5. And then we got the dividend. Dividends, we use the actual exchange rate. So this is 1.4. So all upward, you can get the profit after tax. And above the profit after tax, you have got the taxations. So again, we can use the average rate for the taxation. So we go upward, and then you got this profit before tax. When we get the figures upward, and when we calculate the figure downward, as I've said before, we cannot balance. So this is the temporal method. We know that there is a balancing figure because there will be an exchange difference. Under temporal method, exchange difference goes to P&L. Therefore, we know that there's an exchange loss, 10,550. We can treat it as a balancing figure, but sometimes the question may ask why we have got such a exchange loss. Actually, we should be able to calculate this exchange loss by reconciling the monetary assets. So under the temporal method, why we have got the exchange difference? Because for all the monetary items, we must use the closing rate. We start from a net monetary asset of 70,000. We finish it at the year end, 85,000. So these are the monetary assets that we have. So we start from 70,000, we end at 85. Why monetary assets increase or reduce? Because you got all transactions. We got sales, right? We got sales. From the income statements, we know that the sales was 800,000. We don't care about the sales itself. Actually, we know that we have to credit sales. But actually, when we credit sales, we have to debit cash or we debit receivable. No matter this is cash or receivables, we increase monetary assets. Therefore, sales actually increase monetary assets because you debit cash and you debit receivable. For sales, we have translated it using 1.42, which is the average way. We have purchased something. We purchase the equipment. When we purchase equipment, of course, you debit equipment, but we don't care about the debit to the equipment. We care about the credit. So when we credit, you credit payable or you credit cash. No matter you credit cash or you credit payable, monetary assets reduce. So for the purchase of the equipment, the relevant exchange rate is 1.45. And you have purchased something else. You have purchased the inventory. When we purchase the inventory, right, 490,000, you have translated it using the average way. So therefore, 695,800 monetary assets go down. The same for the operating expense, taxation, and dividends. So for operating expense, for taxation, and for dividends, monetary assets go down. So for this operating expense, taxation, and dividends, you have translated using 1.42 and 1.4 respectively. So operating expense, average way, taxation, average way, dividends, 1.4. So if nothing happened, your closing monetary assets should be 125,300. However, under temporal method, all monetary assets at the year end should be translated using the closing rate. So you are forced to use the closing rate 1.35. Therefore, the monetary assets have to be written down. Written down is something no good. Therefore, this is a debit to the exchange difference. This can reconcile with your balancing figure here. 10,550 debit to the exchange loss.